Have you ever heard of Ronald Red? He was a janitor who passed away in 2014 with $8 million to his name. Yes, a janitor and $8 million. He didn't win the lottery. He didn't inherit wealth. He simply saved money consistently over decades and allowed compound interest to work its magic. The lesson is powerful. How you behave with money often matters far more than how smart you are. You don't need a Harvard degree or a Wall Street job to build wealth. Sound habits can take you surprisingly far. As Morgan Housel explains, financial success is not a hard science. It's a soft skill where how you behave is more important than what you know. Spend the next 10 to 15 minutes on this video, and you might improve that soft skill of investing. This is a top 5 takeaways summary of The Psychology of Money by Morgan Housel, brought to you by Professor Polish, a channel dedicated to financial freedom through every possible way there is. 1. Pay the price. Imagine you want to buy a stylish new watch, something that impresses your friends and your date. You have 2 options: pay for it or steal it and run. Most people would choose to pay because we instinctively understand that valuable things come with a cost. Investing works the same way. High long-term returns usually come with a price, and that price is volatility. Many successful investors favor somewhat concentrated portfolios. The downside? Big swings in value. If you can't tolerate seeing your net worth drop 20% in a single week after disappointing earnings reports, then aiming for maximum returns may not be realistic for you. Consider Netflix. If you had invested heavily 10 years ago, you'd be very wealthy today. But along the way, Netflix experienced brutal downturns, including an 80% drop in 2011. Would you have stayed invested during that period? Could you explain those losses to your family and still sleep at night? Even broad index investors aren't spared. Someone who bought the S&P 500 in 1980 would still endure over a decade in total where the market was down 20% and months where it fell by 50%. Stock investing creates wealth, but it's never free. Volatility is the admission fee for long-term gains. 2. Never enough. Give someone a $2 million bonus and they'll be happy until they find out their colleague received $2,001,001. Capitalism is excellent at 2 things: creating wealth, creating envy. Comparison can motivate us, but it can also trap us in a mindset where nothing is ever enough. A doctor earning $500,000 a year might feel rich, until he buys a vacation home next to a CEO earning $10 million annually. That CEO might then feel small compared to Michael Jordan, and Michael Jordan is still dwarfed by Jeff Bezos. There's always someone richer. This endless comparison has pushed people into reckless leverage, insider trading, ruined families, and even suicide. As you grow financially, you must eventually decide when enough truly is enough. Never risk what you already have and need for something you don't have and don't need. 3. Crazy is in the eye of the beholder. People often appear irrational with money. Some spend wildly, others hoard cash. But everyone's financial decisions are shaped by their upbringing, education, and life experiences. What seems irrational to you may be completely logical to someone else. Take lottery tickets. Lower-income households spend far more on them, even though many lack basic emergency savings. That seems foolish until you consider their reality. For them, a lottery ticket is a rare chance to dream of a better life. Understanding these differences helps you avoid copying investment strategies that don't fit your own goals. A billionaire focuses on preserving wealth. You may need to focus on building it. Recognizing different perspectives helps you stay in your own lane and avoid investments outside your circle of competence. 4. Peekaboo. The Great Depression, world wars, financial crises, and pandemics all share something in common. They were nearly impossible to predict. Nassim Taleb calls these events black swans, They're extreme outliers. They carry massive impact. They seem obvious only in hindsight. Instead of trying to predict disasters, it's smarter to prepare for them. Missing just a handful of the market's best days can dramatically reduce long-term returns. Preparation, mentally and financially, beats prediction every time. Ignore macro forecasts. The biggest shocks are almost always the ones nobody sees coming. The seduction of pessimism. Pessimism sounds smart, optimism sounds naive. Negative stories are more dramatic, more urgent, and more convincing, partly because losses feel stronger than gains. Bad things happen fast. Progress happens slowly. That makes pessimistic narratives more compelling, even when long-term trends are positive. Understanding this bias can help you think more clearly about the future. As Hans Rosling famously said, "The world is better than you think." Final takeaways. You don't earn high return without enduring volatility. Envy is one of the greatest financial dangers. Never trade what you need for what you merely want. Different people require different strategies. Prepare for uncertainty instead of predicting it. Be cautious of pessimistic investment advice. If this resonated with you, check out The Psychology of Money. It's a truly outstanding book. Cheers!